of millionaires are made in real estate. The majority of billionaires are made in private equity.
That's Alex Hormozi. He sold his company Gem Launch for $46 million to private equity. Now he runs acquisition.com, which is a holding company where he buys minority and majority stakes in private companies. I work at a company called Beacon, which is kind of like the AI version of Constellation Software. We buy and grow niche software businesses. So whenever Alex talks about what he does to structure a deal, improve a business, I'm listening and taking notes. I've spent over 40 hours consolidating what Alex Hormozi thinks about private equity and how he runs acquisition.com. But before we go into the specifics of acquisition.com, it's worth talking about why private equity mints billionaires while real estate only creates millionaires. It fundamentally comes down to two words: asymmetric, upside.
There's kind of an upside limit to real estate. You're not going to get a 100x deal in real estate, but you can get a 100x deal in private equity all the time. A business can go from being not valuable at all to 12 months later being worth hundreds of millions of dollars. If you didn't have a way to reliably get customers, and then all of a sudden you find a channel that reliably brings you customers, that makes something that isn't valuable incredibly valuable, right? Or you hire one key person in the business that expands a new territory for you.
The returns in real estate are constrained. There's an upper limit to the amount of returns that you can get by improving a property. In business, on the other hand, there are many things that are within your control and that you can change. You can change the pricing, you can change the product, you can change the way that the company gets customers. And if you compound all of these, that's where you get massive asymmetric upside. But improving the intrinsic quality of the business is just one way that private equity investors actually make a ton of money. There is a specific mechanic, a specific arbitrage that makes a lot of private equity investors quite rich. And this is called the multiple arbitrage.
If you have a business that's doing, call it like $3 million in EBITDA or profit, right, per year, and you can make a handful of tweaks and get it from 3 to 8 million, the $3 million EBITDA business might be worth $12 million, maybe. The $8 million EBITDA business can probably get somewhere between like $80 and $100 million in a sale. And so it's like you have a huge multiplier effect that increases once you get above about $5 million in profit, and especially as you approach 10, where you now become a target for institutional grade investors. So that because they have to put to work hundreds of millions of dollars.
Basically what's happening is you're getting paid twice for your work. Once for improving the profit of the business, and second time for changing the buyer profile, the type of person that is willing to buy your business. So that's the private equity game in a nutshell. Improve the intrinsic quality of the business and also get a multiple arbitrage. But what does Alex Hormozi actually look for when he is acquiring businesses? The first thing to understand is where he plays in the market. There are hundreds of private equity funds, many of them with hundreds of million dollars in assets to actually go out and buy businesses. So where does Alex play?
Typically the business is doing like between $1 and $100 million a year. There's tons of people who help people get their first customer, a few $100,000 in revenue, first 5 clients, things like that. Then if you go like 100 million and up, then you've got like McKinsey, Bain, BCG, Deloitte, PwC, EY, like a lot of these, Gartner, like all these kinds of consulting firms that deal with like kind of above there. But there's just not a lot in the 1 to 100 million range. And what's interesting about that particular range is that that's where a huge amount of like alpha is created in terms of investing returns.
When Alex talks about alpha here, he's talking about his specific skill set. By making a few tweaks in the business, you can actually drastically improve the intrinsic quality of the business by creating a specific sales channel or distribution channel, and also just professionalizing and operationalizing the business. In terms of what he actually looks for, he has basically 3 filters that he looks at.
So if I had to solve for 2 things, it would be gross margin and revenue retention. So fundamentally, like, what do we make per sale in terms of is there a lot of margin that's there? If so, like that's more attractive to me. And then secondarily, how likely is it this person is going to continue to buy from us next year and the year after that?
The reason that gross margin matters is that it determines basically the profitability of the business. So if you're able to sell more units and generate excess cash flow, you can use that for a number of things. If you're a private equity investor, this is particularly interesting because you're likely buying a company with debt. And so having excess cash flow to pay off the debt that you took on to buy this business is important. And also, if you want to scale the business, you can use this profit to actually reinvest in increasing headcount, improving the infrastructure of the business, and many other things. Revenue retention is really important because it's very hard to fill a bucket if it has a hole in the bottom. If you're trying to constantly get new customers to replace your old customers that you've lost, you're basically on this hamster wheel. Having high revenue retention allows you to continue to compound the business without it feeling like you're throwing a Hail Mary every single day. The second filter that it passes through is the LTV to CAC ratio.
The only other thing I'd want to know is, what's my cost to acquire a customer versus my lifetime gross profit per customer? So how much money does it cost me to get somebody, and then how much do they pay me over time? And so basically that fundamental, the LTV to CAC ratio, or LTGP to CAC ratio, I know fancy acronyms, but that ratio between those two numbers is the fundamental economic arbitrage that exists within businesses. Let's say you put $1,000 in and you get 10%, so you're $1,100 at the end of the year. In a business, you could put $1,000 into paid ads and make $30,000 in gross profit in 24 hours. Like, that happens all the time.
Now, that said, one important part of actually buying a business is having access to deal flow, access to good quality businesses that you can actually buy. The thing that surprised me the most in doing this research is how few qualified leads that acquisition.com actually generates through his content. And the emphasis here is on qualified. So he gets a ton of leads every single month, around 3,000 leads applying to be part of acquisition.com, but almost none of these are qualified. They're usually very small and don't actually meet the minimum criteria to be even considered. And so they get automatically filtered out.
We get about 3,000 companies a month, about 100 a day, that come inbound that are that specifically apply for, like, we want to be a portfolio company. We have many more than that just like want help and want information and things like that. But 100 a day come in that fill out a full mini question application. And then those go to my deal team. So we have automated sifting that kind of just in the background based on the application questions that automatically, remove 95%. We don't do any deals outside of the US. So that takes off half because 55% of my audience is international. So we have 45% left. From there, it's like, we don't want other investors on the cap table. That takes another half out. From there, we just kind of like whittle our way down to what are the kind of investable deals. We probably get 2 to 3 deals a day that are legitimate businesses, that are of size, that are US based.
And this goes on to become roughly 2 LOIs signed every single month, which are deals that he's actually serious about. That said, his huge content engine and his massive brand is actually extremely powerful in a few different ways. The first is that basically anyone who gets outbound from acquisition.com is almost bound to take the call, given the massive brand and reputation that they have. The second is that they're basically pre-sold on his playbook and his way of doing things before the negotiation even starts. And the last and most important thing is that he gets preferred economics. People are willing to give Alex a better deal because they just trust him more and they like him more. In fact, that's actually how acquisition.com started in the first place. He started out by doing minority deals for roughly 30% with no cash down. His exchange was basically the trust that he had built off of his brand.
So it's like, okay, your business is worth $2 million. We get 30% of everything above that. And for the work that we do in the meantime, we need cash flow because we have a huge team helping you put all these things together. And so that's pretty much how the deals work.
But over time, he's decided to change his approach. Instead of doing minority deals, he tries to do majority deals. And instead of exchanging work for equity, he's now just started to do standard cash deals in exchange for equity.
Over time, I started writing checks into companies because I noticed it changed the dynamic a little bit favorably for us. And it was less like we're consultants for hire. Now we only do cash in deals. That's probably more traditional.
So we've spent a lot of time thinking about the private equity business model, how Alex gets deal flow, and what he actually looks for in deals. But doing deals is just one part of the equation. That's actually kind of the starting line for acquisition.com. What actually matters is what happens once they actually buy the company. What's his value add, and how does he actually improve these businesses? There are 2 things that Alex Hormozi and acquisition.com is exceptional at in terms of value add. The first is they have this talent arbitrage.
Our ability to attract talent now is unparalleled. And that has probably driven more alpha from the investment than anything. The companies we started investing in, there was no way that some of the top talent that we put in those companies would have even taken a call with those companies.
In fact, that's something that we're seeing at Beacon, and other companies in our space are also seeing, the other AI roll-ups that are out there. We're able to attract really talented people that typically wouldn't want to work on like a specific niche business in the industrial space, for example. The second thing is sales and marketing. A lot of businesses that have gotten to a few $1 million in revenue have typically gotten there through word of mouth, through conferences, and just by being known in the industry. One thing that Alex Hormozi is exceptional at is driving leads to a business and then closing sales. When they go into a business like this that doesn't have even one distribution channel working, they can go in and set up multiple. And in some cases, they're able to 3x a business in a matter of months.
If someone's like, oh yeah, our sales process is horrible, or like, man, we can't get enough demand gen, but we have like a huge LTV and we're really sticky on the back end, like those are companies that we can come in and just murder. Yeah. I mean, we just bought a 32 location teeth whitening chain. And I was so excited about this. And then we went to the facility and the experience was fine in terms of the product, but the sales process that I went through was like, I was like giddy. I was like, oh my God,
it's so
there's
bad.
so many things that we can do to improve this. And so we just rolled out our first level and we 5x'd LTV.
Wow.
In one rollout. And so this is 32 locations. And I was like, great. Like we just created $50 million in enterprise value. Like let's just roll this out over the next 12 months to all 32.
That's a similar capability that we're also trying to build out at Beacon, being able to acquire these niche software companies and then increase their revenue over time. Now, everything that I've said sounds great if you're the person acquiring businesses. It all sounds great for Alex Hormozi. But what if you're the founder of one of these businesses? Why would you be willing to give up 30% of your company, 40%, 50%, sometimes even upwards of 70% of your company to someone like Alex?
Like every PE buyer says, listen, and you could make more on the second buy, right? So everyone's like the same pitch, right? So our average founder return on equity, net of the chunk that we now own, is 13x.
The math is counterintuitive, but it does work. Let's say, for example, you own a $12 million business and you own 100% of it. So if you sell today, you'll sell for $12 million. What Alex comes in and says is, hey, the business is worth $12 million today, but in 2 years, by working with me, we can make it worth $40 million. So if you give up 30% of your company or you sell 30% of your company to us, not only do you get the initial cash out that we'll pay you today, but also you'll own 70% of a $14 million company 2 years from now. That's $28 million in 2 years. And so that $28 million, your future nut or your future payment is actually worth even more than the business is worth today if you sold all of it. And so that's the basic trade that Alex does when he goes to these businesses. If you enjoyed this breakdown, you'll love the breakdown that I did on Bending Spoons. They're a technology holding company that has bought companies like AOL, Eventbrite, Evernote, and Vimeo. And I break down exactly how they do it and how they structure it in this video.